to thank, first of all, Prue and Stuart, the conference organizers, for providing the opportunity for Geoscience Australia to contribute to the conference program today. What I'd like to be doing is I give you an overview on Geoscience Australia's energy resources projects that address the changing mix of energy commodities that is obviously happening now and is gathering pace. But before I do that, I'd like to set the scene in a global context. What you can see here, the forecast on the global energy mixes from 2019 to 2050. And on the left-hand side, you can see the primary energy demand per fuel. What you can see there very clearly is, and it's not a surprise, renewables will really ramp up in relevance and in demand. Coal, on the same timescale, will diminish in relevance. But it is important to note that gas and oil continue to play a significant role. When it comes to global power generation, and this is the graph on the right-hand side, a very similar picture emerges. By 2015, it is forecast that the renewable energies will contribute over 70% to the global power generation. At the same time, again, coal will play a lesser and lesser role, while natural gas continues to be a very important fuel in the mix. I'd like to look then at the Australian scenario, and here we know that in southeastern Australia, on the eastern seaboard really, there is a prediction that a gas supply shortfall will occur by the mid-2020s. So on the left-hand side, you can see AEMO's prediction that indicates even if all committed and anticipated gas projects are coming online, and even if we include LNG imports that have been mooted to assist with the supply shortfall, by 2026, 2027, there is it's forecast that a supply shortfall will occur. On the right-hand side, you can see latest prediction of Cooper Energy, who operate fields in the Cooper Basin and also in Victoria. And they're predicting a shortfall by 2026, mainly driven by the declining gas supply from the Victorian gas fields. So the expected shortfall here will kick in by 2025, 2026. So let's look at what Australia's natural gas resources actually look like. These numbers and these maps are from the brand new publication Australian Energy Commodity Resources that has recently been published by Geoscience Australia. This is the 2021 edition. Here on the left-hand side, you can see the overall resource endowment really with natural gas, and very clearly over 95% of the natural gas sits on the Northwest Shelf. While on the East Coast, most of the gas is related to the coal seam gas occurrences in the coal basins of Eastern Australia. But you can also see there's some additional occurrences of gas that await exploration. However, you also can see by some of the circles that some of the gas supplies in production have severely declined in recent years. On the right-hand side, you can see the unconventional natural gas potential, which is largely untapped in Australia at this stage. So the Beetaloo subbasin is the first one in which Origin Energy recently demonstrated a successful first production testing, and more development and more research is being carried out to ultimately target unconventional gas resources in Australia. So the government, in order to implement what they call the gas-fired recovery and also to address the looming gas shortfall, has implemented the Strategic Basins Plan. This is focused on gas supply for Eastern Australia. The selection criteria for those basins are around resource availability and the proximity to infrastructure. And so far, 3 basins have been announced. The Beetaloo subbasin, most of the work there has been completed, and work in progress is currently targeting the northbound Galilee Basin and the Cooper-Edavale basins in Eastern Australia. It's very clear that the government sees natural gas as the enabler for the expansion of the existing infrastructure and manufacturing capabilities. And Geoscience Australia is taking the lead in identifying the resource potential of those selected basins. Part of this work even includes the assessment of salt storage potential for hydrogen in the Edavale Basin. Also, in order to stimulate exploration in the offshore, the government continues to release offshore acreage for exploration, also with a view to make new gas discoveries. The recent release was conducted on the 15th of June. 21 areas were released in the offshore with a closing date for work program bidding by the 3rd of March 2022. Geoscience Australia supports these releases with a wealth of open file access to open file data, but also by providing information, regional petroleum geology per basin, which you can access on the website listed here on the screen. Geoscience Australia also supports the annual acreage release with dedicated pre-competitive studies, one of which is the late Permian to early Triassic biostratigraphy and sedimentology of the southern Bonaparte Basin. Here we have a gas-producing basin. It's enjoying current exploration activity, and further gas development has been mooted to bring the Petrel, Tern and Frigate gas fields online. So the aims of our study here is that we want to address sedimentological controls on the reservoir quality, reservoir characteristics. We want to develop a paleogeographic model that describes the changes in sedimentary facies associations in time and space, but also apply high-resolution biostratigraphy and palynology to further delineate the position of the Permo-Triassic boundary in that part of the Northwest Shelf. So far the initial results very clearly indicate there is a diachronous development of the marginal marine facies during the late Permian. It's also interesting to note that so far we see that the Permo-Triassic boundary is not well represented by lithological change, and it is most likely that the lateral changes from high to low energy environments really are the main control on reservoir characteristics. The southern part of Australia, a major data acquisition program and interpretation is on the way. Here we have 6 new areas were released in the Otway Basin, targeting the underexplored frontier regions in the deepwater region. So this revolves around the acquisition of new regional seismic data, deep seismic data, and Geoscience Australia is currently involved in a review, the prospectivity study of that deepwater frontier on the major basin really. So here we see some of the outcomes of the data. There's a thickness map of the top Cretaceous. And here you can see the numbers. It's quite an extensive survey. Many thousands of line kilometers have been acquired and been reprocessed to come up to a much better understanding on the regional geology of this basin. So we will deliver an updated tectonostratigraphic framework, and also importantly, Geoscience Australia contributes has very major input into petroleum systems modeling. Some of the results of this modeling are outlined here. It's a snapshot really, and interestingly, some of the results indicate there's actually a generation potential of liquid hydrocarbons in the underexplored section of the Otway Basin. The Australian government is also aware that there is a need to reduce greenhouse gas emissions. So one of the initiatives here is that the government is now offering offshore acreage for greenhouse gas storage. Nominations for the 2021 Greenhouse Gas Acreage Release have been received and are under review. And this will provide opportunities for companies to obtain acreage to explore for offshore greenhouse gas injection and storage locations. Thereby, we support the initiatives to accelerate the deployment of carbon capture, use and storage by applying new technology to reduce emissions. So the government is on track to release the first set of offshore greenhouse gas acreage before the end of this calendar year. Now I'd like to switch over to onshore projects, and one of the main large projects that is currently being carried out at Geoscience Australia is the Exploration for the Future program. This is a program that is meant to attract investment into exploration for and the development of Australia's mineral, groundwater and energy resources. It comprises 8 projects, and 4 of those projects are focused on energy commodity resources. So firstly, there is the Australia Resources Framework. It's a nationwide continental scale project. Then we have the Officer Musgrave project, which is focusing on the resource potential of a largely underexplored region in Central Australia, mainly the Officer Basin. Then we have the Barkly-Isa Georgetown project, which continues to provide results from a previously undertaken research activity in northeastern Australia. And I like to focus a little bit more on the Australia's Future Energy Resources project, which is being carried out in part of 4 modules. So what we want to do here is we want to address gas and possibly oil by defining new petroleum systems. We want to investigate the green hydrogen, the utilization of renewable energy. We want to look into blue hydrogen, combining petroleum systems and carbon capture and storage. And we also want to look into oil resources by utilizing carbon dioxide for enhanced oil recovery. The initial focus of this entire project is centered around the Central Australian basins represented by the Eromanga, the Simpson, the West Cooper, Bernecker and Warburton basins. So I said there were 4 modules. Module 1 is a resource assessment. It comes in 2 major activities. Firstly is the well failure analysis. We want to understand why previous exploration was not granted with commercial success. We want to use that information then to feed into a prospectivity study and ultimately come up with a prospective resources assessment of these partly underexplored regions. Okay, module 2 revolves around hydrogen. Here we want to understand the hydrogen storage resources in key locations across Australia and estimate the geological hydrogen resource. It's important to understand that practical hydrogen storage options are a key unknown in the establishment of a new hydrogen export industry, with salt storage being the ideal storage option. Therefore, part of the module will also try and map out the occurrence of salt storage locations in Australia. If this is not available, or additional opportunities may be represented by depleted gas reservoirs or even hard rock caverns that are not utilized anymore. And also the module contributes to the hydrogen economic fairways tool, which I will talk more about in a later slide. Module 3 of the FAR project revolves around the carbon dioxide enhanced oil recovery in residual oil zones. Carbon dioxide enhanced oil recovery can unlock remaining oil resources while permanently storing carbon dioxide at the same time. So at the moment, GA's analysis of Australian oil-producing basins has identified that CO2 EOR is feasible in many depleted basins, or mainly depleted fields, that is to say. Residual oil zones are similar to depleted fields. They're oil-bearing reservoirs, but they have undergone natural flooding with water. So we can distinguish here between brownfield. Those are the oil zones that are associated with still producing fields. And we have the green fields. Those are the ones that are not associated with any pay zones. We believe there are potentially significant oil and CO2 storage resources in Australia. We are encouraged by the results coming out of the Permian Basin in the United States. So in the EFTF, in the FAR context, the question is, can we find producible residual oil zones in Australia? And also, the module will focus initially on the Cooper-Eromanga region. Module number 4 is the basin inventory, and this provides a snapshot of the current knowledge, the regional petroleum geology of mainly underexplored basins in Australia, with a focus on the eastern part of Australia. The outputs include basin assessments, the recommendation for future work to enhance the prospectivity or the understanding of the prospectivity, and the identification of knowledge and data gaps. Those reports will also be supplemented with selected petroleum systems modeling, and some of the results will also be directly feeding into the source rock atlas that has been created in recent years and is available for access on our web pages. So I'd like to finish off pretty much now and talk a little bit more about Geoscience Australia's hydrogen projects. As indicated before, mapping potential hydrogen storage locations is a key activity, and also the investigation of natural hydrogen occurrences. Geoscience Australia has developed a hydrogen opportunities tool, which is based around GIS-capable mapping systems that utilize online data for hydrogen production prospectivity, but also able to track the development of future hydrogen projects around Australia. In collaboration with Monash University, Geoscience Australia has then developed a hydrogen economics fairway tool, which combines large-scale infrastructure and hydrogen-based data sets to conduct a geospatial analysis of the economic viability of hydrogen operations across Australia. And here's a snapshot of this tool, which is an interactive tool. It is available on our portal. The website is listed down there. And you can, as a stakeholder, you can enter your data according to what you believe is the key requirements to make your project feasible and economic viable. The system will then crunch the models for you, and it will come up with a map highlighting the most optimal locations for hydrogen projects to be established in Australia. So things like gas prices and also the current hydrogen price per kilogram will play an important role in really utilizing this model and this tool. So with that, I'd like to finish. The summary, very clearly, Australia's energy mix is changing very rapidly. And the Australian government's energy initiatives are currently twofold. First of all, the speedy recovery from COVID-19 economic downturn, but also the government is very keen to accelerate Australia's journey towards a low-emission economy. Clearly, the government sees natural gas as the enabler for the economic recovery and the expansion of renewable energy networks in Australia. Geoscience Australia's energy resources projects are adapting to the rapidly changing energy mix, and by assessing the resource potential of the newly required energy commodities, we strongly support Australia's transition to a low-emission economy. So I leave you with a number of websites for your information. I believe and I encourage you really to utilize the portal. This is an interactive data discovery tool, and I'm pretty sure you find it useful, not only in hydrogen space, but across the various data sets that Geoscience Australia has made available. So thank you very much for listening, and I hope you enjoy the networking later on.
Poor Tom. Thank you very much, Tom Bernecker. That was an interesting presentation and beautifully presented too. I'm actually going to give him a 10 for that because that came up absolutely beautiful. And he had a little bit of humour at the start as well, which is good, goes down well as well. We're going to stick with the pre-recorded theme at this point in time. Our next presenter also couldn't make it into Western Australia. He's a little bit further afield, I think in Singapore at the moment. He made a bit of a wave 12 months ago when he was appointed to the company. Mike Utsler is his name, and the company, of course, we're talking about is Otto Energy. Mike is an oil and gas executive. He, again, has more than 40 years of experience in senior international oil and gas sector roles, and he led the Gulf recovery operation following the Deepwater Horizon incident that many of you may remember as well. Let's make him very welcome here today as he represents Otto Energy Ltd. Thank you.
Hello and good afternoon, and thank you for that warm introduction. Again, my name is Mike Utsler, and I'm the Executive Chairman for Otto Energy. And this afternoon, over the course of the next 10 to 12 minutes, what I would like to do is to share with you who Otto Energy is, what our focus is, and why you should consider Otto Energy as a great opportunity to invest and be a partner with. Our primary focus starts with our organization and the people that enable us to deliver on the success of our business to date, as well as what we see in terms of future opportunities. We have an experienced leadership team made up of 5 individuals with more than 130 years of experience in the oil and gas industry. We also have a technical team made up of 4 to 5 individuals who, again, have more than 150 years of experience. So all total, in terms of the resources that are driving our pursuit of developing value for our shareholders, we have 270 plus years of experience. And extensively, that experience ranges in the oil and gas industry from literally around the world to a significant proportion of that experience focused on the Gulf of Mexico. Why the Gulf of Mexico? Well, specifically as a junior listed oil and gas entity on the Australian marketplace, as we've evolved as a company looking at where are the greatest opportunities for developing and capturing resources, where is the lowest cost in terms of developing those resources, and where do we see potentially the lowest risks and greatest opportunities from a marketability standpoint to manage the consequences and outcomes of that, we look at the Gulf of Mexico as being one of those principal basins. It is one of the world's largest oil and gas basins. In the US, it is the largest oil and gas province. It is been in operations onshore since the early 1900s and offshore since the 1950s. It is a prolific hydrocarbon basin with extensive existing infrastructure. It has tremendous fiscal stability in terms of terms and conditions and tremendous access to multiple marketplaces in which to enhance the value of our product. And so the Gulf of Mexico, while it is very mature, still yields significant opportunities for growth and for the opportunities to materially convert that growth into real value in the oil and gas energy business on a global basis. Our focus in that period since entering the Gulf of Mexico in 2015 has allowed us to evaluate extensively the Gulf of Mexico onshore and offshore to identify those areas that we think are liquids rich, oil and gas prone, with significant upside. And over that period of time, we've looked at over 280 asset opportunities or prospects from 2015 to today to potentially participate in. The outcome of that is we've had 3 world-class quality discoveries to participate in the Gulf of Mexico. South Marsh Island 71, which is one of the top 10 oil and gas discoveries in the conventional Gulf of Mexico shelf environment in the last decade. The onshore Matagorda County Lightning Field, which is one of the largest gas discoveries in onshore Texas in the last decade, and then a deeper water development subsea tieback in the Gulf of Mexico known as the Bullet Field, GC21. Our program, as we've shown in terms of our development over these past 5 years, has led to a significant successful track record in terms of both success case economics and full cycle economics against the backdrop of an industry that's been challenged in its abilities to return value to its shareholders. When you look at our performance as a company, there's significant positive results, both in that success case as shown on the slide behind me. When you then look at what does that mean in terms of the opportunity sets on a go-forward basis, you look at the fact that we currently have, through those 3 assets, an R/P of 9 years with more than 4 million barrels net resources to be developed and to be produced by those existing 3 fields. In addition, within those 3 fields, there's an additional 2.3 to 2.4 million barrels of oil equivalents that can be developed in lower cost, high probability of success, high rate of return, infield development potentials associated with those fields. And then finally, we see upsides on a longer term basis, on a 2C basis, for an additional 2 million barrels to potentially be developed within those 3 fields. The real strength of this is the fact that the existing discoveries and subsequent development of those 3 fields has now resulted in the infrastructure being in place and therefore significantly lower cost on a go-forward basis. We estimate that our additional capital to develop that 2.3 million barrels of 2P resources is in the range of $13 to $15 million net over the next 2 to 3 years, which would be a 50% uplift and taking our economic life from 9 years to 14 years, 13 to 14 years under current pricing structures and scenarios. So significant lower capital on a go-forward basis within our existing asset base to develop those additional resources and to yield substantially improved economics associated with future developments. Specific to that, if you look at historically, our cost of finding and development in the Gulf of Mexico has been approximately $21 per barrel for finding and developing those resources, with an additional $10 to $12 associated with the direct field lifting cost and indirect overheads associated with that production historically. On a go-forward basis or look-forward basis, we see that development of our remaining resource potentials in these 3 fields to be in the neighborhood of $8 to $10 a barrel of oil for finding and development. We've substantially worked with our operators to reduce the operating costs associated with those 3 fields, and currently those costs are approximately $4 per barrel of oil equivalent, and we've reduced by 40% our indirect, our overhead costs as a company in the production of our resources, equaling, again, another $4 per barrel. So all in, we're looking at $16 to $18 per barrel of oil equivalent on a go-forward basis to produce 6.5 million barrels of net resources that are within our control. That outcome reflects a substantial enhancement in both our economics and our improvement in balance sheet to continue to grow our opportunities to invest in future growth potentials. And you can certainly see that as we've, in this next slide, as we've converted those economics into balance sheet, it's created additional capacity for us to now focus on what next, where next, and how do we grow on that existing asset base and to grow our company and to create value for our shareholders. So in doing so, with production expected to increase over the next 2 years, free cash flow expecting to increase, we then look at how and where and what will we do with that increased capital available to us as a company. What I want to assure listeners is that we've approached this from a learnings experience to ensure that we are fiscally disciplined, both in our existing asset base in terms of future investments, as well as any future investments to grow the company inorganically through additional resource developments, acquisitions, and/or mergers. And those are shown in the slide behind me in terms of the specific criteria on a financial basis that we're using to enhance our decision-making as a company and to remain disciplined in that approach. What are we looking to invest in as a company is we will continue to be focused on the Gulf of Mexico, both onshore and offshore. That is where our expertise and competence, we believe, allows us to yield a significantly greater return for our investments on a go-forward basis. Those investments will be focused in the inorganic growth through the drill bit, as we're seeing a significant number of opportunities during the down period over the past several years within the industry. Entities across the Gulf of Mexico, onshore and offshore, have been high-grading their portfolios, and they're now seeking partners in which to leverage their capital exposure in the rapid development of those potentials. We've looked at more than 80 different prospects in the last 6 months being brought to market in the Gulf of Mexico, with several of those meeting our economic thresholds and criteria that we're pursuing further evaluation and potential participation in. In addition, we're looking at the opportunities because of the volatility in our industry across the globe, as well as in the Gulf of Mexico, at potential asset and/or company acquisitions. To be clear, we recognize that size and scale matters in this industry going forward, and that we recognize the importance of Otto Energy positioning itself to grow. And that can be either through the drill bit, it can be through acquisitions or mergers with other entities to create scale and capacity to access both capital, investment potential, as well as resource potentials. But it also may mean the selling of our individual assets or the company as a whole to enable somebody else as a combined entity to grow. We are agnostic in that space. At the end of the day, we will make our decisioning on the basis of how to create the greatest value for our shareholders on a return basis. One example of that we've already implemented in 2021 was a successful conversion of a large tract of acreage position in Alaska, in which we were a non-operated party owning 10%, to a position in which we've been able to convert that to shareholdings within a pure play Alaskan explorationist into the marketplace. And that market value of those assets now resides on a daily basis somewhere between $9 and $11 million potential for us to be able to leverage in terms of additional capital for future growth potentials. That's one example of the kinds of strategic opportunities in which to create value on a future basis. So in summary, Otto Energy's focus remains on the Gulf of Mexico, onshore and offshore. It is an area where we have the technical expertise, the commercial and financial expertise on which we believe to build growth, to create value for our shareholders. We will continue to focus on our existing 3 assets, to optimize those assets, and to advance the development of the additional resources that are held within those fields, as I mentioned in my presentation, where we expect over the next 3 to 5 years to expose an additional $13 to $15 million of Otto capital to develop 2.4 million barrels plus or minus of additional resource potential into production. We will continue to evaluate through the drill bit opportunities for growth. We've seen a significant ramp up in activity sets in 2021 by other operators bringing opportunities to the market, seeking capital to support their growth agendas that we believe are viable for us to participate in, so long as they meet our very stringent and disciplined fiscal parameters that we've outlined here in this presentation, and we've made publicly available. Bottom line is, we look to grow this company to create value for our shareholders through the existing asset base that we own, through optimizing the performance of that asset base and investing prudently and fiscally the opportunity sets to convert our balance sheet into increasing the size of the company and therefore creating additional value. I want to thank the conference for the opportunity to present Otto Energy to you who are in attendance today, as well as those who may be watching this, and to encourage you to look further at Otto Energy as an opportunity for the future. Thank you very much.
Otto Energy, is it going to deliver value for you as a potential shareholder? Thanks very much to Mike, and thanks to all of our presenters who've been doing a bit of a hard job online today. Fortunately, technology is on our side. We're back in the room now, and I've got a question for you. Do you know the name of the biggest gas well to be drilled on the Northwest Shelf for decades? Do you know what it is? Our next presenter does, correct, and you do too. Like its namesake, this particular well and the company partnership behind it may be in to win the biggest race in the nation, and maybe in there to win your shareholding loyalties as well. Will Barker is the man coming up on stage at the moment. He joins us for Good Oil, representing Western Gas. Now, Western Gas is a private company. You may not have heard of it, and they're in partnership with listed GLV, Global Oil and Gas. They're going to be drilling that well. To bring us up to speed, would you please welcome Will?
Thank you very much, Christina, and pleasure being here, and lovely to see everyone in the audience late in the afternoon like this. But as we heard, Sassanov, not a household name right now, but 100 years ago, it definitely was. In 1816, it won the Melbourne Cup and set the country alight with its delivery in winning that race. What we're here to do today is give you a background on Sassanov, a background on what we're doing in Western Gas, and with our listed partner in GLV, be able to undertake the drilling of what is going to be a truly massive event for our industry, and for us as for a company, and hopefully our shareholders, to deliver success on the Sassanov drilling program. So quickly, a bit of background on Western Gas and the Equus project, which includes the Sassanov drilling program. So we were fortunate, myself and my business partner, Andrew Leibovich, who've been working together for the last 10 years, to be building a portfolio of assets in our own backyard here in WA. We initially started onshore in WA in the Canning Basin, where we have our Goshawk Energy, and we had a partnership there with Hess, the big American firm, Emirata Hess, who you guys would know well. They'd had a long history here, drilling offshore in the Northwest Shelf via their Equus project. And we were very fortunate that 2 oil crashes ago now, back in 2015, they weren't fortunate. They were in significant financial trouble, and they made the decision to exit Australia. It gave us the opportunity over the next 18 months to work with them. We knew them well. We'd been joint venture partners with them, and we knew the assets in our own backyard well. And what we were able to do was acquire 100% interest in the Equus gas project. For a junior, this is an extraordinary opportunity, that we have 100% control of a very large acreage position sitting in the heartland of Australia's oil and gas industry. We sit there between the giant gas fields of Scarborough, the super giant gas fields at Io, Jance and Gorgon, and just offshore from a gas market that currently has 47 million tonnes per annum of LNG production capacity. That market scale is huge. We hear a lot about gas shortages on the East Coast. The gas requirements to keep those 47 million tonnes per annum a year of LNG capacity full is over 7 billion cubic feet of gas a day. That's 10 times the gas market of New South Wales and Victoria combined. So this is the heart of our industry. And this is where we as a junior are very fortunate to have 100% control of a mature asset. That asset has seen over $1.8 billion spent to date. Been over 21 wells drilled, and remarkably, they accomplished an exploration success rate of 88%, 15 discoveries from 17 wells. We're here today to look to replicate that success, but on a much larger scale with the drilling of the Sasanoff prospect. We've secured now the Valaris MS-1 drill rig, which is state-of-the-art Generation 6 semi-submersible drill rig, currently drilling on the Van Gogh fields for Santos. And we have secured a drilling slot in March next year to come and drill our Sasanoff prospect that sits in our 519 licence area. That target is a 7 to 17 trillion cubic feet exploration target directly adjacent to our best field, which is called the Mentorque field. Mentorque is a field that was drilled by Hess back in 2010. It's a beautiful flat spot, a direct hydrocarbon indicator that stands out like the proverbial dog balls, that has 2 wells in it. So the original discovery well at Mentorque 1, and then followed up by a full appraisal well, Mentorque 2, that underwent extended production testing. The reservoir quality at Mentorque is first class. You've got porosities at over 30%, permeabilities in the range of 4 to 11 Darcy, 60 metres of net pay, beautiful water drive reservoir. The individual wells on production test floated over 300 million cubic feet a day. So enough gas from one well to supply the entire New South Wales market. What Hess knew at the time was they had seen the beautiful flat spot at Mentorque, but they only had seismic data to this point right here, their original licence area. So they had seen what they referred to as the Archer prospect, but they hadn't seen what we have gone on to do over the last 3.5, 4 years as we've matured the exploration story, what we see as a much larger structure, a structure that's on the scale of the Scarboroughs, the Iogants, the Gorgons that surround us here. And that's what we refer to as our Melbourne Cup winner, as Sasanoff. All of our fields, by the way, are ex-Melbourne Cup winners. So what we did when we took over the asset, so the licence here, 519, was awarded to Hess in September 2015. As I mentioned, oil price crash had occurred late 14, early 15. They were bid on the licence in 2014, awarded in 2015, and what they unfortunately never did was acquire the multi-client 3D seismic data that extends over all of this area. We've taken that seismic data, we've conditioned it with the 21 wells we have within our own licence areas. We've brought in the other discovery wells at Pinho, which is a Chevron discovery in the same formations of the lower Barra Group just to the west of us. We've fully conditioned that data. We've undertaken all of the quantitative interpretation. We've brought in down under Geosolutions, who have undertaken all of the fluid typing studies. And we now have ourselves in a position where we're stepping out from a known discovery at Mentorque into a prospect that is world-class at that scale, that has independently been assessed by our new joint venture partners in GLV and their contractor ERC Equipose, who have undertaken that independent study. That's delivered us with a prospective resource of 7.2 trillion cubic feet of gas and nearly 200 million barrels of associated condensate, with an upside that stretches us into that 17 to 20 TCF range and nearly 500 million barrels of condensate. Very importantly though, with all the geological work that has been done on this prospect, the independent expert has put a 32% chance of success on this play. So we are extremely excited about it and looking forward to getting on with the drilling program in March next year. As I mentioned, GLV has announced just yesterday has farmed in for a 25% interest in Sasanoff. It's a 2-for-1 farm in. They're paying 50% of the well costs to earn a 25% interest in the prospect. They also completed yesterday, undertook a fully subscribed $11 million capital raising of firm commitments that's now going through its shareholder approval process. What that does for us is bring in a great partner who is aligned to drilling this well. That we are able to, in a short period of time, deliver results into the market on a scale that will be a complete game changer for a company the size of GLV. GLV currently testing in there with fluid samples that you can see out on our booth outside of the condensate. Our focus here is drill the well and then recover fluids to surface and be able to book the first resource and reserves across the Mentorp field. So high impact drilling, very simple well design, scheduled to commence in March next year, 25-day drilling program to be able to deliver those results on a well that's costing sub US 20 mil. So hopefully I've given you an overview of Sasanoff, of the opportunity that we have. And we think it is a very unique opportunity to be able to drill such a high impact well for a junior company, both private and listed, to participate in a drilling of the scale of this on the Northwest Shelf is something that hasn't been seen for many decades, 30 plus decades back to the original exploration in this area. So we really appreciate your attention today, and we look forward to making Sasanoff a household name, not only in our industry, but around WA and around the country. So thank you very much.
Will Barker, if people take nothing else away from your presentation today when thinking of Sasanoff and the investment potential, I will take away that it is, what did you say? It has a potential, potential that sits out like dog's balls. So remember that always. And also when you're having a bit of trouble, I know, but when you were having trouble remembering which race it was that Sasanoff won, so I went back and I checked. So it was 1916. It's the second Kiwi horse to ever win the Melbourne Cup. It was one of the only days that the Melbourne Cup was actually postponed. So it was postponed to the following weekend because it rained so hard. And also 12-1 were the odds. 12-1, so pretty long odds. But on a beautiful show of gesture of friendship, the guy that owned it on the day of the race sold a third of it to one of his best mates. So his best mate could share in the potential of what he thought was going to be a big win. So who knows? That may be what you're doing today. Thank you so much, mate. Cheers. Love useless information. Also, before you Before you get up here, sir, can I just take a moment? I've got a little prize to give out. Who likes a bottle of Grange? Fabulous. Who put the, good on you, Darren, you would. Did you put your numbers in to the bean counting, the little bit of bean counting? Did anyone do that? Okay. How many? Put your hands up. Put your hands up nice and strong. All right. Stay standing. Stand up, would you please? Stand up. Anyone that put their little hand in for the bean counting. Quickly. I haven't got all day. Stu, you'll come down here and have a go at me. All right. Who said more than 6,000? Stay standing. Did you say more than 6,500? Stay standing. Now, Jackie Moxham from Gallagher, who has donated this great prize, was out there and she's actually counted each bean individually. And when you hear how many are in there, you're going to go, oh my God, she probably needs to go and grind those beans and now eat them all. All right, 6,800 or more, stay standing. 6,900 more, stay standing. Did you guess 7,000 or more? Stay standing. All right, I'm going to tell you what the actual number was. The number was 7,024 beans. And the person in this room that was closest to that, for the winner of the 2017 Penfolds Grange is... I've lost your name. I've got to... Oh, shit. Hold on a second, Rachel. Wait, someone help me here. Right. A few came close. The winner of the Grange is... I don't know. Quick, someone come and read this. Someone come and read this for me. Darren, you're a good data analyst. Have a look at that. Can you find a name on that, Matt? I've just gone mad. Wait, I've got it over here. Jackson gave it to me so I couldn't let people know, which is very cunning, Jackson. And Jackie's probably going, my God, who is that woman? But I'll mention the name Gallagher as again. I should have had some coffee and I didn't. You won't find it. It's on this card here. All right. This person is 7,123. Roberto Bertolini, who knows his coffee. Come on up, sir. Are you here? Where's Roberto? Excellent. Let's just drink his Grange for him. That's fabulous. All right. Well, thank you so much for all your help. We'll sort that out between us, Jackson and Prue and I and Stu. We'll work that one, a 2017 bottle of Grange. Thanks to the team at Gallagher. All right. Andrew Knox, do you want to come up and join me on stage, sir? Ladies and gentlemen, please put your hands together for Andrew Knox. Red Sky Energy Ltd are next to take to the stage here at Good Oil. Now, Red Sky is an ASX-listed oil and gas exploration and development company that acquires, drills and develops all gas resources that can be produced conventionally using proven advanced technologies and also develops best practice methods. Maybe I've got into the Grange already. That's why I've got a furphy name there. Look, you guys have been in the news a fair bit in the past few months, sir. Andrew Knox is the Managing Director. He has over 35 years of experience in the upstream oil and gas sector. Let's find out what the upside might be for us if we choose to invest in Red Sky. Please make him welcome again.
Thank you, Christy. Good afternoon, everyone, and thank you for staying the course. Obligatory disclaimer. This is a corporate snapshot of the company. We have a lean team. Rob Analyst is our chairman, veteran of the industry. A lot of you here would know him from his 30-year tenure at Lakes Oil. Myself, start off as a roughneck for my sins. Adrian Wing, the corporations and ASX listing specialist, is also a company secretary. And our team, management team, Bill Lodwick, geophysicist, exploration development manager, who's got over 40 years experience around the world, and Serge Tulakima, a reservoir engineering and new ventures manager, 30 years also in various jurisdictions, and who's with me here in the audience today. ROG is the ticker code. We've got a market cap of about 42 million. We've no debt. We've just had a raising. We're well funded. And the top 20 shareholders have about 23% of the shares out. This is where we are. We're mainly based in South Australia, asset in the northern Cooper, and one down in the southeast of South Australia in the Penola Trough. We have a legacy gas asset in Wyoming in the US, and our head office is in Melbourne. I must say it's great to be back free range in WA. This is a look at our projects. We have 100% of the Killanoola oil field in PRL 13 down in the Penola Trough. We have a 20% interest in Inaminka, which we farmed out to Santos, who have the remaining 80% up in the Northern Cooper. And we have 100% of the Gold Nugget gas asset in Wyoming. It has about 5 BCF, but we regard this as non-core, and we're looking to divest of that asset. Our strategic approach has been to acquire production or near production that is value accretive for our shareholders with near-term cash flow. We think we've been reasonably successful with that with our acquisitions at Inaminka and Killanoola. The plan is obviously to develop these resources and convert them to booked reserves. With further appraisal and exploration, and we have 3D programs planned, acquisition programs planned at both sites. Just focusing in on the assets, we acquired 100% of PRL 13, which has the Killanoola oil field from Beach earlier this year. We raised funds to support the work program. There's about 7 million barrels in place. The guesstimated recovery range is about 40%, which equates to 2.8 million barrels. And we've done some work that we think we've identified significantly upside with new pay zones. It's a waxy crude. It's 34 API, but it's got high paraffin content, and we're looking at ways to mitigate that to ensure we've got a stable oil flow. This is a top reservoir depth map of Killanoola. There's 2 existing wells on the permit. DW1 in the north, which was the discovery well back in '98, drilled by Ocker. And there's one down the southeast, SE1, drilled in 2011. DW1 in the north, reports show that it's flowed about 300 barrels of oil per day. And it's got a pump at surface and production tubing, and we're looking to bring that well now back into production to get a live oil sample and assayed out of the existing 5 meters of pay. We're also running slick line in the SE1 just to make sure that that's free. We commissioned additional petrophysical work on both these areas. And we think potentially we've got 42 meters of pay at DW1 and about 16 meters of pay at SE1. Our plan is to wireline and perforate both these to get improved flow rates and obviously this will extrapolate into significantly increased resources and reserves eventually. Then we will look to bring in a rig and put these both on production. There's also a block in the middle, Killanoola South. This is untested, but has the same geological setting as the other two-way dip, two-way fault closure. And we will eventually look to drill this prospect. Post this, we're also looking at a 3D program we're going to start in next quarter, which we will use as the basis for our full field development. Turning our attention to our other project in Inaminka in Northern Cooper, we've got 20% interest in 6 contiguous licenses known as Inaminka Dome. We farm these out to Santos, and Santos have the remaining 80% in our operator. In these licenses, there's the Yarrow gas field, which gross has about 20 BCF of gas, Flax oil field with 10 million barrels and 20 BCF of associated gas, and Juniper about 600,000 barrels. And there's 3 exploration blocks to the southeast. Flax and most of Juniper are covered in 3D, and the rest is blanketed pretty much in 2D. Flax was previously produced about 180,000 barrels till it was shut in a few years ago due to oil price crash. The facilities are there in the top right, in pristine condition. Needs a couple of load-out pumps and a starter on the flare, but otherwise in good shape. So we farmed out these to Santos, and the terms are that Santos have to drill a vertical well in the Yarrow gas field for us, a horizontal well in Flax, 3D program over Yarrow, and carry us through the development phase, which part will be repaid out of production. The 2D existing over Yarrow was reprocessed, and that in conjunction with the 3 already existing wells on Yarrow, we've confirmed a final well location, and Santos have that in their drilling program, and it's going to be drilled in November in the 4th quarter this year. Whereupon we'll look to shoot the 3D and tie it into the Santos grid to Napawi to the southwest there, about 17 kilometres away, through a 4-inch line, which is about has about 20,000 MCF capacity a day. Post that, then we will drill the horizontal well at Flax and tie the associated gas there back to the Yarrow development. Just a look at our resource position, 2C basis. We've got 2 million, this is net to Red Sky, 2 million barrels of black oil at Flax, about 4 BCF of gas. At Yarrow, we got about 4 BCF of gas, and at Killanoola, 2.8 million barrels of black oil. And this adds up to 6.42 million barrels of oil equivalent. So we have a busy time coming up. We've multiple fronts. We're going to bring the DW1 well back into production. We're going to perforate eventually both wells and bring those, but complete both as producers. We have seismic also over Killanoola starting in the 4th quarter. We have free carried Yarrow gas well in the 4th quarter. And then further out, of course, there's 3D seismic at Yarrow and development, as well as a horizontal well further out then in Flax. So why would you put your money into Red Sky? Well, we think we've got low capex, near-term revenues. The operations are de-risked. These assets have already produced in the past. Wells have been drilled. There's infrastructure in place. The economics are robust. Oil and gas prices are both very strong. And there's lots of upside with the newly identified pay zones at Killanoola and exploration to the east in Juniper and blocks in Aminka. In summary, we've got 3 oil and gas projects in Australia's Finola Trough and Cooper Basin. We're targeting near-term cash flow, modest capital, a free carried Yarrow gas well in the 4th quarter, 3D seismic to be acquired at Killanoola in the 4th quarter. Prices are strong, and all the projects have existing contingent resources with potential upside, as well as exploration upside. And importantly, everything's funded. We've raised money for all our current work program. It's all through cash on hand, covered through cash on hand or through free carry. Thanks for your time.
Thank you very much, Andrew. Appreciate it. Should we, shouldn't we? There's so many decisions today, is there not, team? So many, and this next one may be one for you as well. I did say that I thought we had finished with all of our pre-recorded presentations. We have one more, and this one is coming to us from Melbourne, from FAR Ltd. Cath Norman is the Managing Director of FAR Ltd. She is a professional geophysicist. She's got 20 years experience in the mineral and oil and gas exploration industry, and she's held executive positions both in Australia, also over in the UK, and carried out operating assignments in Europe, Africa, the Middle East, and here in Australia. She's got a really strong background in the application of traditional and innovating geophysical technologies in the search for oil and gas, and also in new business development. Would you please welcome Ms. Cath Norman, Managing Director of FAR.
Good afternoon. It's a pleasure to present at the Good Oil Conference this year, albeit from my home in Melbourne, which is where FAR is headquartered. And of course, we're still in lockdown. FAR is an Australian-listed oil and gas explorer who has had enormous success in finding oil and gas offshore West Africa. In 2014, we discovered the giant Sangomar oil field with our joint venture partners offshore Senegal in West Africa. In fact, in 2014, the Senegal oil discovery was marked as the world's largest oil discovery for the year. There are 5 billion barrels of oil in place, that is, in the Sangomar oil field, and Woodside is taking 440 million of those barrels to development, with first oil expected in around the end of 2023. Unfortunately, though, although successful with exploration, like a lot of companies, FAR was not alone. in having a difficult last 18 months in the wake of the oil price crash in March 2020. It saw the lenders withdraw from the debt financing to FAR's participation in the development of the Sangomar asset, and as a result, we took the decision to sell our stake in the field. In November last year, we announced that we had struck a deal with Woodside, and that deal completed on the 6th of July this year. On selling our share in that development, FAR now has just under $170 million in cash, as you can see in the top right box, and we intend to distribute $80 million of that cash by capital return to our shareholders later this month. It also means that we're fully funded for our forward work program in the future. You can see, though, that our market cap is less than our cash backing, and that largely reflects the fact that the ASX suspended the trading in FAR shares last year for the 10 months while we completed the sale to Woodside. But we're back now trading. We're a leaner organisation. We have a new board. We have a focus on capital discipline, and we're going back to doing what we do best, which is creating value from successful exploration. We have a large portfolio of assets in West Africa, and in 2 months' time, we spud one of the world's deep water wells to watch for 2021, which is the Bambo-1 well offshore the Gambia, drilling into the extension of the Sangomar oil field and targeting about 1 billion barrels of oil. Senegal and Gambia are both on the westernmost tip of Africa, and shown on this image here is the Sangomar oil field in green with the gas cap shown in red, just to the north of FAR's 2 blocks, A2 and A5, offshore the Gambia, which is the country directly to the south. You can see clearly that the Sangomar oil field extends to the south into the Gambia, and in fact the location of the Bambo-1 well is only 500 metres from the border to the south, drilling into the extension of the Sangomar field that we call the Solo prospect. Not only are we drilling the Solo prospect, but we're drilling 2 other prospects that haven't been drilled yet by the 8 wells that were drilled into the Sangomar oil field over the last 6 or 7 years. We're using a very experienced drill team. We've drilled offshore Gambia before, and we have a great relationship with our joint venture partner Petronas and the host government of Gambia. Let's take a closer look at that Bambo-1 well. You can see from the table on the bottom left that we're targeting 1 billion barrels of oil gross, and if successful, that results in a discovery of 559 million barrels net to FAR. We're drilling through 3 prospects: Solu, the extension of the Sangomar field, Bambo to the upper in the section, and Solu deep, deeper into the section. Solu, being the extension of the Sangomar oil field, carries the highest chance of success, being 29 to 36% chance. And even though on success we're hoping to find 500 million barrels net to FAR, we've done our success case planning based on 150 million barrel discovery, which in fact is the P50 or best estimate volume we're expecting to see in the S410 reservoirs, which is one of the main reservoirs in the Solu prospect, as you can see in the bottom right of your screen. On success, we are anticipating that we may plan a development which is a conventional oil development consisting of oil and gas producing wells and injectors tied back to an FPSO or floating storage and production offtake vessel. If we look at 150 million barrel development, that results in 64 million barrels net to FAR. And this development is conventional, so it does carry low technical risk and also allows for tying back more barrels that we may discover either in Bambo or in future discoveries down the track. We've developed an economic model based around this development concept, and the output of that is a rough distribution of the revenue shares from first oil. And you can see from the barrel of oil that we've annotated in the bottom right that about 27% of any revenues go back to the contractors, being FAR and Petronas, and a total of about 35% goes back to the government of the Gambia, which is made up of corporate tax and the state share being the working interest and the royalty. Of course, any more barrels we find above the 150 million barrels are more valuable because generally the capex and operating costs will not increase, but the profitability per barrel will increase to FAR. So we're hoping to find more than 100 million barrels. But the model does show us that the minimum economic field size out here is about 100 million barrels. So how are we going in terms of readiness to drill the Bambo 1 well? Well, as I said earlier, we've drilled out here before, so the environment is not unfamiliar to us. We are due to be spudding the well at the end of October this year, and the well should take most of November to drill. It's being drilled in about 1,000 metres of water with a Stena IceMax drill ship. Our headquarters will be based in Banjul, but we'll have a shore base in Dakar, where all the supply boats will be supplying pipe and other goods to the drill vessel. Of course, COVID-safe practices are one of our main concerns, and we have those in place, and we're not expecting those to delay the drilling campaign this year. The rig is actually operational offshore Mexico at the moment, so we won't be taking a cold stacked rig. It'll be proven and operational and ready for us to accept before the drilling campaign late October. ESG is very important to FAR, and it's very important that the government takes a healthy, roughly 35% stake of the income from the development of any oil offshore Gambia. It's going to allow the government of Gambia to not only develop their nation, but to lead in the transition away from burning heavy fuel oil for electricity development by having cash flow into the country. Our social projects are also really important to us. We run them all ourselves. We've invested in hospitals, developing health clinics, including a COVID-19 clinic, and we manage all those projects ourselves. So all of our social investment goes into the projects and not to external managers. So whilst FAR is all about Bambo and drilling those prospects in the next few months, I'd be remiss in not telling you that we actually have a much wider portfolio outside drilling Bambo. You can see from the table on the bottom left that we'll be testing 3 of our mapped prospects in A2 and A5 with the Bambo well, but we have additional follow-up opportunities that we've mapped on recently acquired 3D seismic, both in our A2 and A5 blocks. They total about 682 million barrels gross, so about 340 million barrels net to FAR, and represent upside in our portfolio. I'd like to walk you through what the exploration opportunity looks like for FAR, starting with the Sangomar oil field, which is a known oil field sitting on the shelf edge of a carbonate platform, being fed by oil generated in a source kitchen deep out to the west. You can see on the bottom left that the seismic line that I'm showing you here is right through the Sangomar oil field, and I'm going to step through south and show you the prospects further to the south in the Gambia. The first, of course, is Solo and Bambo that will be drilling with the Bambo 1 well, just to the north of our blocks in A2. You can see that they have easy access to this source kitchen, and in fact that source kitchen is very prolific. To be generating enough oil to house 5 billion barrels of oil in place just to the north in Sangomar means we've got a really rich source rock that's capable of generating a lot of oil in this region. As we step further south, you see that we have the Jobo prospect of about 280 million barrels, the Jato prospect about 130 million barrels, and then Marlo, a very large prospect out to the east, about 265 million barrels, all on a P50 best estimate basis. So lots of follow-up in our A2 and A5 blocks. We're not just about drilling Bambo this year. And in fact, FAR's got an enviable position along the shelf edge to the south of Senegal, with 3 more blocks offshore Guinea-Bissau. And in fact, shown on the table to the bottom left, you can see the prospects that we'll be drilling with the Bambo well, our Gambian prospects that I've just showed you, and in fact more upside in terms of some rather mature block prospects that we've got mapped heading for drilling in 2023, post farm out by FAR. There are very few wells, as you can see, that have been drilled on this margin. In fact, but the Bambo-1 well will be the first well that's an exploration well that's been drilled for 3 years. So what does our forthcoming program look like? Drilling, as I said, will take place all of November for the Bambo-1 well. And in fact, if successful, we may even drill an appraisal well towards the end of next year. We have a planned well in Guinea-Bissau for 2023. It's a commitment, and our joint venture is looking to bring in an operator and farm down so that FAR's costs are largely covered by drilling that well. So in summary, FAR is a successful explorer. We have been successful in finding oil offshore Senegal and continue to test our prospects offshore Africa with drilling in Gambia. We have a world-class exploration team that's been proven as oil finders, and we've got over 2 billion barrels of exploration prospects in our portfolio. We've been exploring offshore Africa for about 16 years now and have developed deep contacts with the state governments in the areas in which we operate, and we have an extensive database of seismic data and well data to work with. We've also remained small and nimble and able to pick up opportunities as they present themselves. We've formed strong partnerships both with the host governments in the countries we operate and with our international joint venture partners. We're emerging as a company with good capital discipline. We're returning $80 million to our shareholders. We're remaining capital light, and our risk management strategy has always been to farm out exploration wells and to offload the cost of our exploration. In fact, over the last 8 years, FAR has farmed out $250 million worth of work program in exploration and also sold our Senegal asset for an additional $127 million. So we're a proven company in terms of capital discipline and risk management of our exploration portfolio. It's left us in a position, of course, where we're fully funded for our exploration going forward. So if you like the story I've told you so far about FAR's prospects, then let me explain the value proposition to you. We're currently trading at well less than cash backing. And in fact, if you include the cash that is a future payment from Woodside as part of the settlement of the transaction with them, then we're trading at about half of our current cash. The graph shown here has been converted to cents per share in terms of our cash. 80 cents a share will be returned to shareholders this month. 34 cents a share will be used in drilling the Bambo prospect. And at the end of the drilling campaign, we'll have about 56 cents a share or $56 million left in the FAR coffers in cash. That'll leave us in a great position to take advantage of any success case planning and also capture new opportunities that present themselves to FAR. Of course, there's no upside value built into our share price for any of our assets, let alone the potential for us to find 1 billion barrels of oil offshore Gambia with the Bambo drilling campaign. Our current share price is $1.29. It's cash backed at $1.70. It's cash backed at another 74 cents if you consider the future payment that's coming from Woodside. It represents excellent buying and some near-term news flow and very deep value with the portfolio of assets that we have. Thank you very much for allowing me to present the FAR story today. I look forward to hearing from a number of our shareholders and taking any questions in due course. You can find us at our headquarters in FAR in Melbourne, and I'd be remiss without showing you the disclaimer that accompanies this presentation. Thank you very much.
Thanks again, Cath. Cath Norman. And Evie is her representative who's here if you'd like to go and have a chat with Evie on any of the things that Cath has raised there. We're coming back to the Perth Basin now. Strike Energy has just concluded a 5-month heat needle survey across that company's geothermal acreage in the Perth Basin. And time to analyse the data. A man who'd have an insight into that is Stuart Nicholls. Stuart, can I invite you up here, please, sir? Stuart joined Strike as its CEO and Managing Director back in 2017. He led the transformation of Strike from its exploration roots into one of Australia's first integrated developers of gas, renewable energy and fertilisers. He's got a broad-ranging background across the energy landscape, and that includes time in the up and downstreams at Royal Dutch Shell across most disciplines, primarily from within Royal Dutch Shell's gas businesses. He has a key focus on the transition of the energy system and his commitment to lead Strike to net zero in 2030. Big claim. Let's see you do it, sir. Please make him welcome.
Thank you very much. Reminds me to shorten that intro next time. Okay, those that don't know Strike, we are a fully integrated fertilisers, renewable energy and gas developer. We have a vast acreage position, upstream acreage position in the Perth Basin, where we are looking to develop not only a domestic gas source, which we will bring online in early to mid-2023, selling about 8 to 9% of Western Australia's domestic gas on a daily basis, but we will then take that gas endowment and we will value add to that, building a co-located and adjacent fertiliser urea plant up in Geraldton. That's 1.4 million tonnes of fertiliser for Australia's about 2.1 million tonnes of fertiliser consumption, all of which I might add is pretty much imported. That entry into fertilisers is also integrated from the point that it actually lets us enter into the hydrogen economy. You need hydrogen to make fertiliser, but you also need CO2. The fertiliser plant that we will look to build up in Geraldton will be one of the largest hydrogen and carbon sinks in Australia once operational. Now, we have a couple of core competencies at Strike, and we're starting to really hit our straps on those. First and foremost is the identification, mapping and understanding of the Permian sandstones of the Perth Basin. The second core competency is putting holes into that. Now, ultimately, that core competency has led us into a third arm of our integrated strategy, which is the identification of what appears to be a Tier 1 world-class geothermal resource, which is co-located in the Kingia sandstones along with our gas resource. This has all come together and has propelled the company recently into the ASX 300, and we've come together ultimately for an integrated approach which will allow us to deliver 2030 net zero Scope 1 and Scope 2. That is the most aggressive and ambitious net zero commitment from any energy company in Australia, and is held up against the yardstick of Fortescue and Future Industries here as being a 2030 decarbonisation program. But today we're talking about the natural gas part of the business, and fundamentally that is what will get us up out of our seats. It will get us moving into cash flow. Strike, with a large group of geoscientists and geophysical professionals, some who are international, some who are located in our head office down here in Western Australia, in West Perth. We are a proudly West Australian business. We looked at the Waitsia discovery, and then we just said to ourselves, this looks like a big deep water offshore play trapped onshore as a result of a rift basin and a whole bunch of other significant play mechanics coming together about 275 million years ago. This Permian gas fairway, as we called it at that point in time, we put a well down to 5,100 metres down into West Erregulla and uncovered the West Erregulla gas field. That was the second gas field found in the Permian gas fairway. Very quickly after that, we saw Bahara Springs Deep found underneath the old Bahara field. And then very happily today, I read in the news that our friends in Mineral Resources in Norwest, a quick shout out to them, have made a discovery at Lockyer Deep. That's 4 major gas discoveries in a very short period of time, from about 2015, 2016 to where we are today. You can see the Permian gas fairway illuminated through a near Caringinia 3D visualization up in front of you. One of the things to note about the Permian gas fairway, and which we have always talked about, is that the play will get thicker as you move down into the south and to the east. This has been proven by every well penetration to date, as you can see located up in the top left-hand corner. If I add Lockyer Deep's 26 metres of gross reservoir with a high net to gross in it, that will, let's call it 25 metres of net pay. That's probably about right, is it, Neil? That also fits into this geological model where as you move down into the south and the east, the play gets thicker whilst the quality is maintained. Recently, we've been drilling for about a year now. Wish it was a shorter time frame, but that's where we're still getting better at some of the things that we do. We have been delivering very consistent geological results from the Permian gas fairway. West Erregulla 2 was 43 metres of net pay, and we've seen West Erregulla 4 drilled with 28 metres of net pay, West Erregulla 5 with 32 metres of net pay, all around the same horizons, the same gas compositions. And then we've had West Erregulla 3, which gave us a little bit of a boot in the Karanjini, and we'll be coming back to that well, and we expect excellent results from that well as well. And so one thing to take away from this is the really high success rates that have been delivered from the Permian gas fairway. 15 wells have been drilled into these strata, of which 100% have found conventional reservoir development. And we had 89% success rate until this morning, which was very nice of MinRes and Norwest to tick us up to 90% success rate. Of those deep wells, 9 of 10 have been the basis of large conventional gas discoveries. So the success rate of this play is really quite up there for global geological standards. So what did I do? I sort of thought I'd do a little bit of homework for everyone. I took the great work done by MinRes and Norwest, by our friends at Beach and Mitsui, and also by ourselves, and I amalgamated all of the opportunities that are currently published out there for prospects and leads and gas fields that are found in the Permian gas fairway. And what you can see up there is a vast array of opportunity where that success rate can be applied to that sort of level of prospect and lead identification. You can see South Erregulla sitting there with a big yellow position just under West Erregulla. We see that on both the 3D seismic and the adjoining 2D seismic that there is communication and connectivity of both of the structure as well as the reservoir that moving across down into our 100% owned permits. The good news for Strike is that we are at the centre of attention right now. Through the discovery of the West Erregulla gas field, proving that there is poorer perm inversion at those depths, we have been able to bring people around us, activity around us. That activity will drive down cost for us and for our fellow operators, and it will increase the amount of gas being produced out of the Perth Basin. This means lower processing costs. This means lower mobilisation costs. It probably means rigs being located in the Perth Basin on a permanent basis. This is a really exciting development for all of the operators of the Perth Basin and some of the explorers who are going to come and make their leap towards where we find ourselves today. One of the really key things that you can take away from this map is we've been talking about South Erregulla for a while now. Recently, we conducted a data trade with Beach Energy. We conducted the mapping of the South Erregulla tail, and you can see that that was recently published by Beach as well, almost identically. And so Strike's subsurface mapping is being validated by Beach Energy in that southern portion of South Erregulla. Very exciting indeed. So recently we just shot some 2D seismic. We have a different approach to seismic. We want to get new information into the business as quickly as possible. One thing I'll point out about the Lockyer Deep discovery announced this morning is it was the first King Year discovery made solely on 2D seismic. The reflectivity sequences that have been identified in that 2D seismic are equivalent to the ones that are correlatable in the 3D. Do we need to be shooting vast quantities of 3D seismic now in order to be able to identify new gas resources and have the confidence of drilling new holes? The answer is probably not, looking at the seismic that we've recently pulled out from the north of South Erregulla there from our Mayor 2D seismic campaign. You can see the cross sections of this seismic where we've mapped the gas down to, where gas has been observed down to at West Erregulla, and that is giving us a very good amount of confidence that the South Erregulla structure sits nicely pronounced above that gas, observed gas down to subsea depth with great reflectivity. You can see the sweetness cubes of those two lines there. You've got nice bright spots popping right at the right levels for the King Year. And we're also seeing persistent frequency and velocity attenuation, which maps what we saw at Lockyer Deep. So the play is continuing to evolve. We are right at the frontier of it. Strike is the leader of exploration in this part of the basin, and we're very excited to put a well into South Erregulla later this year. It only represents a casual 1.6 TCF of gas in place. Now, that gas in place will ultimately, once we recover that gas, not only look to supply the gas required for the feed for our fertiliser plant, and we'll see Project Tabor off and running, but will also give us an opportunity to put additional volumes of gas through the Erregulla plant, through into the domestic gas market, and another exciting opportunity I'll take you through in a moment. Just before we drill South Erregulla, we thought we'd turn our attention to fixing some of the old wrongs from the basin. There's a play towards the south, a Jurassic play called the Catamaran coal measures. It's a wet gas play, a bit shallower than the Permian. This play has been a frustrating piece of geology for many explorers of the Perth Basin for a long period of time. It hosted the Gin Gin and Red Gully gas field, which ultimately Empire Oil and Gas was producing from. It is a play which is made up of fluvial channel complexes, which has a lot of heterogeneous reservoir distribution. And unfortunately for Empire, they did not get good quality 3D seismic down over their gas field, and they started to drill wells that were less productive than the wells that they needed to keep their gas plant full and enter MinRes as a new operator in the basin. But what we did is we got a bit of good quality new 3D seismic over the Walyering gas discovery. Walyering was a discovery made in 1971. It floated about 13.5 million standard cubic feet a day, about 300 barrels of condensate. It was such a success at the time, they in fact diverted the Pamelia pipeline to Walyering to bring it online. A couple of appraisal wells later, Walyering 1 waters out. It's been left for a very considerable period of time. Until 2001, another appraisal well came in and thought to drill just up dip of Walyering 1. It again didn't quite find what it was looking for. We've gone back and redone the petrophysics of that well. It did in fact just scrape the gas field. And if you actually look at the amplitude blooms, which are diagnostic of coarse river channel sands, they're not hydrocarbons, but conventional quality reservoir, you can see Walyering 1 was drilled into a small fault compartment to the west of the field, and ultimately Walyering 4 was then just drilled just on the edge of it. We see about 3 metres of net pay, about 15% average porosity. So what are we going to do? We've got our 3D seismic, we've illuminated the area, and we're now going to follow the structure, follow the amplitudes, which are diagnostic of those conventional river sands that we're chasing, put a hole in it and bring this play back to life. What this will do for us is it will bring 270 square kilometres of leads and prospects that we already have mapped through the Ocean Hill to Walyering trend in the Catamaran coal measures into our prospect portfolio. This will revalue a large portion of our acreage, which is currently given a $0 valuation due to its checkered history for explorers and producers. We're also very fortunate to be carried to a degree by our friends at Talon Energy. Dave Casey, a guy I know quite well, he was the CEO of Warrego Energy at the time that Strike and Warrego made the West Erregulla gas discovery. We've got a great working relationship, and I'm looking forward to getting back into drilling operations with Dave. So it's been a busy 4.5 years, and now it's going to be another busy year in front of us. And you can see that there is a reperf and a retest of the West Erregulla 5 well coming, and that's followed by South Erregulla, Walyering, a West Erregulla 3 completion, and then we've got an optional slot which we're currently identifying whether we're going to give it to the gas business or the geothermal electricity business. Now, what are we going to do with all that surplus gas? Well, good news is that the downstream opportunity study was released recently by ASIL Allen after JITSI, the Department of Jobs, Tourism, Science and Innovation, sanctioned that report. That report came back and the West Australian government said, okay, those that are looking to support downstream investment in Western Australia may have an exemption to the LNG export ban of pipeline gas. Now, that's going to be a great opportunity for Project Tabor to not only benefit from the funds that are going to be allocated to downstream developments and the approvals pathways, but first and foremost is by developing Project Tabor, we may get our opportunity to export some gas. Now, exporting gas in Western Australia is an obvious target. It's the Northwest Shelf. Northwest Shelf is declining. We've seen precedents from the Perth Basin of Waitsia as well as offshore at Pluto entering that capacity. That plant's going to need more than a BCF a day by 2030. Bear with me. And On top of that, you've got a Chinese LNG offtake contract, which is rising in the total percentage of production, which is driving down the potential for the Northwest Shelf to generate free cash flow. So the Northwest Shelf wants it, Strike wants it, the government wants it, everyone wants fertilizers. It's going to happen. If you start to use the LNG spot price of today, sitting around $20 US an MMBTU, and you walk that back through the Northwest Shelf, down the pipeline back to the Perth Basin, you're looking at an Australian dollar cost of around $20 a gigajoule. That's only just a cool 14 Australian dollar a gigajoule margin on top of the domestic gas price of today. So we're bringing our gas plant online. We're looking to bring the first cash flows into the business. It will be a massive achievement for the small company that was Strike only a few years ago. And just the thing I want to let you know is that all small companies started, all big companies started somewhere. Okay.
Yeah, it is. Well done, Stuart. Thanks so much. Tim, we have one more presentation to go today. It's great to see the strength in the room here as well. Before we get there, I just want to clear something up. Robert Bertolini, are you actually in the room? Roberto Bertolini, are you in the room? Right, we're going to do something interesting with that bottle of Grange, team. I'll be thinking about what that is. I just want to see if you were or were not here, so I can give you a chance. Right, we're going to have a bit of a, what did one of our presenters call a little while ago? We're going to have some networking after this last session today. So I'll invite him straight up here. The fellow is Peter Strachan. Peter is a 38-year veteran of the finance industry. He's got a prior background in metallurgy and geology. He's currently host of Stockheed. He's here today to talk profit from oil and gas production in a world of mega mergers and decarbonisations. Would you please make welcome Peter Strachan?
Thanks very much. Look, today I'm going to be telling a whole lot of lies, and I'll be making extraordinary claims and so forth. And so really, I'd just advise you that anything I say is not investment advice. I no longer have a financial services license. I paid my $900 to ASIC to cancel it. Yes, you have to pay ASIC to cancel your license. So please, I might even mention a few companies as we're running through this, and that doesn't mean that I'm recommending them. I'm using them as an example of what we want to say. So really, the title is How to Profit from Investment, even in petroleum companies in a world of mega mergers and decarbonisation. And to know where we're going to go, we need to know where we are at the moment. So I put this graph up from the EIA, which just shows you where oil production was from 2016 to 19. As a number of people have said, we're up around 101 million barrels of oil a day at that point, and it fell on a quarterly basis back to 85. I'm sure on a monthly basis it was below 80 barrels of oil a day, with 6 or 7 million barrels a day of oil that goes into jet fuel not being used, and we all know, no one was driving their cars and so forth. But today we're back at about 97 million barrels of oil a day, and OPEC are telling us that their output is still 3 to 4 million barrels a day below the pre-pandemic peak, and they can produce that. Well, let's see, and I think EIA is also forecasting that oil production will in fact peak beyond where we were. And if we look at OPEC's production, you can see that yes, the production fell from around 42 million barrels a day down to 32 million barrels a day, and it's recovered. And it would seem as though they have about a 4 million barrel buffer there, but do they? And so you look at these graphs here, and you can see the graph at the bottom shows that Saudi rig count, which was chunking along in 2016, 17, 18 at about 60 to 65 rigs in operation, is now down below 30 rigs. And those rigs back in 1916, 1917, were a lot of them were drilling for gas, because Saudi Arabia actually imports gas from Qatar. So if you're not drilling for oil and you continue to produce it, then guess what? Your production rate falls. The same thing has happened in the United States, where oil production rigs have fallen dramatically, and we had 1,500 more rigs back in the day. During the COVID pandemic, it fell down to around 200, below 200 rigs, and it's recovering, but still not at the rate that we've seen. And so America's oil production is, I think, still down around 2 million barrels a day from where it was pre-pandemic peak. Still, they're drilling more efficiently with horizontal wells and so forth, but the production from legacy fields is always declining. I just want to look at the shale gale and what happened in the United States. If you look at the Bakken shale production, that seems to have peaked out at about 1.5 million barrels of oil a day, and would appear to have about 1.5 billion barrels or 27% left. And it's now producing at about 1 million barrels of oil a day. And if you look at the long-term history of the Bakken, and I was there in 2007, 2005, when it was all just beginning and everyone was really excited, but the Bakken shale play over its whole life has actually absorbed $36 billion. So it actually hasn't, if you look at the money that's gone into drilling holes in the ground and all of the purchasing of assets and putting in pipes and infrastructure, and subtract the actual revenue that you've got from selling the oil, you're still down 36 billion. So it's been a complete sink, a cash sink. And I don't think the industry's, not going to, the sort of people who've been backing this. The only people who made money were the actual drillers and service providers, and those people who managed to sell their assets, and flip them on the way. So if we look now at what drives oil demand, we're seeing that in fact GDP growth there really drives energy growth. And as the GDP has been growing on a 3-year average at around 1.5% per annum, guess what? So is the oil demand, keeps on growing at about 1.5% per annum, energy demand. And so here we are looking at where we are. And this is the global energy supply. It's not just energy used for electricity production, but it's all energy. And you can see that 85% of energy today comes from those nasty fossil fuels, oil, natural gas and coal, whereas renewables, or I would call them rebuildables, because if you build a wind turbine or a photovoltaic cell, how long does it last? If PV cells are 20, 25 years, maybe you have to chuck them in a hole in the ground and do it all again. So it is rebuildables, about 4% currently. And hydroelectric, well, how many rivers at the moment still don't run into oceans anymore? I think most of the hydro is basically tapped out. But we are moving into a new world of renewable or rebuildable energy, and hydrogen. People talk about hydrogen, and there's going to be a role for that, but even the people who promote hydrogen say it's 10 or 20 years away. And remember that hydrogen is manufactured, and even though people are saying here that they found hydrogen in the ground, it's not normally found in nature. It's the most reducing agent in that we know, and any molecule of oxygen that it comes close to is going to hydrogen will grab it and turn it into water. So now we get to the crux of it. If we look here at the bottom, this is energy. The Earth's population carrying capacity depends on the type of energy sources used. Non-fossil fuel energy is capable of supporting approximately 3 billion people on the planet. And we look at the white line at the bottom, that's non-fossil fuels, which is hydro, solar, wind, wood, biofuels, etc., nuclear. The rest, the red, the yellow and the brown is the fossil fuels. And you can see that population growth mirrors that very closely. And back in 2000 and in 1971, when Paul Ehrlich wrote The Population Bomb, the world's population was about 3.7 billion. We've added 4.1 billion people in the last 50 years since he wrote that book. And about 82 million people a year, and that is what has been driving the energy demand. So where are we and where are we going? So BP, this is what BP thinks is going to happen to the oil production and demand. In fact, people don't talk about peak oil anymore, they talk about peak oil demand. And so oil supply The path has been set, and if you look at the middle line there, that means that BP is seeing that oil demand will fall from about 100 million barrels a day currently to about 47 million barrels of oil a day by 2050. So 47 million barrels of oil a day is still a lot of oil, and the difference in the energy is going to have to be made up by all these rebuildables. So we're going to have to build a lot of photovoltaics, we're going to have to build a lot of wind, and then we're going to have to store that energy when you've got a surplus of weather-dependent power generation. And storing in batteries is going to be a big thing. But I think this is the thing that I think the hydrocarbon industry is going to have a coal moment. And we've seen here, these are this graph is already quite a bit out of date. It's July 2001, and what we've seen overnight was that coking coal delivered into Jiangqing in China, $450 a tonne. 18 months, 2 years ago, that was around $120 a tonne for coking coal. Thermal coal out of Newcastle wasn't so long ago, that was $54 a tonne. Today it's around about $178 a tonne. So, the banks have run away from financing coal production. Investors don't want to hold shares in coal. Rio Tinto sold its coal business. BHP is getting out of petroleum. But you know what? The coal miners today are making a poultice. And you know what? They don't need the banks because they're making so much money that they can finance their developments through cash flow. And I think this is what the oil industry is going to see. It might be called the last hurrah, but I think for the next 10 or 15 years, with oil price now at $72 a barrel, and as Eric has said, it's been around about $100 Australian a barrel. Last time Australia oil price was $100 a barrel, the US price was like 120, 130. Our Australian dollar was, $1.10 to the US in those days. And here is a closer look at the individual components of the energy we use globally. And you can see that coal actually has peaked out. It looks like that peaked out about 8 years ago and is falling now. Oil is still rising. Natural gas is the one that's really going, and we've seen reasons for that with natural gas replacing coal in the United States and elsewhere. I don't think they haven't built a coal-fired power station in the United States now for about 25 years. And as they're closing them down, it's being replaced by renewables, which is the others, and it's been replaced by natural gas, which has been up until now very cheap in the United States. So, the rivers are mostly tapped. The major growth in rebuildable supply will be, that's where all the money's going at the moment, into rebuildables. But what you see is that the growth in demand for energy outstrips the amount of rebuildables that are being built. And so to meet the total demand for energy globally that we need, we're actually seeing more fossil fuels being consumed. So lithium ion, we're going to need storage. That's batteries, flow batteries, pumped hydrogen, green hydrogen. They're all part and parcel of it. So what I want to do is have a look at what's going to happen to Woodside if this merger deal with Woodside and BHP Petroleum goes ahead. There's about 10.1 billion barrels of oil equivalent in the new company, and on the right is their producing assets and the projects that are sanctioned. I put big red crosses over a few of those thinking, well, they're stranded assets and they won't actually ever be produced. But if we look at 6.4 billion barrels of 2P and the 2C that I think is reasonable to come on, like Scarborough and Trion, then there's a value there from that I'm guessing, and no one, please don't hold me to my word, that that would be about $32.40 a share for the merged Woodside. If you said that those barrels were worth $6.80 on a barrel of oil equivalent basis, or if they were worth $9.70 on a barrel of oil equivalent basis, that would be about $45.60 a share, and that's giving zero value for 3.7 billion barrels of oil equivalent of options and stranded assets that I don't think will ever be produced, but they might. I mean, who knows? Myanmar, that gas might come through, or there might be, I mean, as FAR was saying, there's 5 billion barrels of oil in place at Sangomar, and they're doing this work on about 350 million barrels. So I'm sure there's going to be more than 350 million barrels produced out of Sangomar. So my numbers on Woodies is that at the date of the merger agreements, the enterprise value of Woodside was $17 per barrel of oil equivalent of 2P and $5.25 per barrel of oil equivalent of 2P and realistic 2C. I mean, if you put in all of the 2C that was in that model, that's about $2.40 they were trading at, already very cheap. BHP Petroleum will be purchased for about $13.50 a barrel of oil equivalent, or about $4.34. So it's actually reducing the underlying cost or the value of the company in terms of dollars enterprise value per barrel of oil equivalent. So Woodies is doing pretty well buying those BHP assets, and they may have an option to sell their interest in Sangomar. I mean, if they want to stay in first world jurisdictions and don't want to go to West Africa, they could walk away with, say, $1.5 billion and move on, use that as the equity to build Scarborough. I'm not saying they'll do that. I think it's a great project, but they could. I think they'll generate somewhere between $8 and $13 billion in free cash flow a year, or $4 to $7 a share as a merged entity. And in 2024, at prices between 65 and 85 high and low. Earnings of about $2 a share, puts them on a PE of about just less than 10, a yield of about 6.3 at $65 a barrel, or a PE of about 5.5 and a yield of 10.8 at $85 a barrel, which I think is probably where we're going. And even if you just say on a dividend discounted basis and say they pay $1.50 a share forever and a 6% discount, that's worth about somewhere between $21 and $36 a share, depending on whether you use $65 or $85 a barrel. So where do we find value in a decarbonised world? You've got to be looking at oil and gas producers. I think the explorers are going to find it difficult unless they can find some way of financing themselves. Advanced economies are spending all their money on this area that I've circled there, the solar and wind. In America, they're putting in a lot of batteries. This is recent from EIA, and you can see that the amount of batteries are going from just under 2 gigawatts to about over 12 gigawatts in 3 years, a 6-fold increase in the amount of batteries, lithium ion mostly, in the United States. But even then, that's only 1% out of a 1,117 gigawatt market. It's not that the batteries are going to have to be charged from somewhere. Batteries don't, they're not an energy source, they're just a store. And so the batteries have to be filled up. So new energy opportunities, obviously lithium ion battery makers, suppliers, materials, graphite, graphene, lithium chemicals, copper, nickel, cobalt, we all know this. Renewable energy, we've got a number of companies here. Linus is in production. There's a couple there in the wings. We've got flow batteries with zinc bromide, Red Flow, which is an Australian listed company. Some are dabbling around with vanadium redox batteries, which is an Australian invention. There's a fantastic invention in hydrogen fuel cell technology. It's an unlisted company called Lavo. Fantastic technology, I think. Solar photovoltaics, there's the makers and installers. We're not smart enough to make those things here, apparently. Wind projects, there's developers. Pumped hydro, Genex, they're going to go into solar and wind as well. There's people who are using waste heat efficiently, geothermal efficiently, Kalina Power, Australian company. Microgrid developers, hydrogen, there are long-term opportunities, but I'm not going to hold my breath. There's a lot of people out there saying, oh, we're going to gasify coal. Like they were doing that when I was born, like 70 years ago. It's a 100-year-old technology, and they're going to turn the coal gas into hydrogen, and then they're going to turn it into ammonia. And that's like thermodynamics. There's a thing called thermodynamics. If you have 100 units of energy, very good methane, as someone said to me, and you turn that into hydrogen, and then you turn that hydrogen back into electricity, you get 30 or 25 or 30% of the energy you first started off with. So you're better off to use that energy that you got rather than make hydrogen with it, because unless that energy is costing you nothing and you just have to store it. So I just want to, my disclaimer, all of that is complete bullshit and you shouldn't understand any of it. And I just wanted to reference, there was another slide there, and There's a guy called Simon Michino who's a professor, an Australian guy, who's a professor in Finland, and he's basically said that the amount of energy required to build all of the renewable energy machines that we're going to need, we haven't discovered all the copper and lithium and graphite that we need to do that yet, let alone produced it and manufactured and fabricated it into whiz-bang machines. So I'm not at all confident that we're going to move to a totally renewable energy future, certainly not as our population goes from nearly 8 billion currently to 9 billion in the next 13 years and 10 billion in another 15 years after that. So that's all I got.
We love it. Pete, tell us, why did you have to pay to give your licence back? How does that work?
ASIC. They charge like wounded back. I mean, I'm going along, trying to do a good thing and tell people what's good and who the good guys are and who the bad guys are. And then they say, oh, you have to pay $1,500 a year. For what? Like, what services do I get for that? Imagine if, as a financial services license provider, all your clients, you just randomly sort of give out a fee. And you have to, normally you have to show what the fee's for and provide, you've done a service. ASIC just 1,500. Then you got auditors and oh my God, every bastard wants to sue you for defamation. It's just not worth doing it.
But I just don't understand why you had to pay the $900 to get out.
Yeah, I said I want to
That's
give my
just wrong.
license back. I've been a licensee for 19 years and had a fantastic time. People really love what I do. And they say, oh, well, just send in $899 and we'll cancel your license. I said, no, I just want to, what if I don't pay
Ridiculous.
it?
Thank you so much for talking to us. You're a crazy man. That was really interesting. Good and pragmatic, telling us how it went. It's been a full-on day, hasn't it? We've had 26 presentations. Some of them have been on time, some of them have been overtime. I reckon most of them have been very, very interesting, some of them super entertaining. We started well with our almost mini TED Talk on the Perth Basin. We've had some great discussions on data, some really interesting potential for you to invest in. Congratulations to those of you who are watching from the eastern states who have stuck with us, and for those presenters as well who have gone to the effort to make us fantastic presentations that we can share with everyone in the light of COVID restrictions. I think we've done a bloody good job, and we should put our hands together for Jackson and Prue and Stuart and all the team. Well done, guys. And big Shane up the back, who I'm sure had more hair before we started today with our logistical challenges that he had. We'll be back here tomorrow morning to do our next presentation. Won't talk a lot about that in light of what you just said about batteries and lithium, etc. But there were definitely places to invest in with that one. We are starting a little bit earlier, 8:30 a.m. We will be having drinks just like we're going to do right now at 5:10 out in the exhibition hall. So come join us and introduce yourself to some of our presenters. Thank you, everyone. Thank you for coming today.